Let's say that we start at 10 and make a 10% move up. That takes it up to $11. However, when this stock makes a 10% move down, it breaks that $10 barrier. The reason being that 10% of $11 is $1.10, taking it back down to $9.90. The next 10% up move is only based upon a price of $9.90, which is 99 cents. Therefore, it fails to take out the previous high. Of course, the next down move of 10% is from the lower price again, and so on, hence into that awful downtrend. Now, can you imagine the damage that could be done if a double ETF against an underlying stock which was in a downtrend, in other words, the drops were bigger than the rises in percentage terms? Can you imagine the damage that could be done? Now, this isn't to write off the idea of double ETFs, because let's just go back to that horrendous chart we saw earlier. Of course, the moves are exactly the same. The move from 667 to 1334 is just as much of a double for anyone investing at 667 and riding it up to 1334 as it was for someone lucky enough to get in at 10 and ride it up to 20. It's all about market timing. These double ETFs, you have to be on the right side of the move, and they're not for buy and hold investors. It's as simple as that. They're a trading vehicle. And this goes just as much for the double inverse ETFs as it does for the double long ETFs. One thing to consider is that many of these ETFs and the double inverse ETFs pay dividends and sometimes have quite a large payout once a year. I think this is in order to kind of offset some of the problems that we've talked about, which get evened out over a year by the fund, and then they sort of do a payout. But to put that in perspective, DXD, which is double inverse the Dow, in 2008 paid out $20.24 in dividends, the largest being on the 23rd of December, and that was $16. And that stock, which is the double inverse of the Dow, DXD, was trading between, say, 50 and 80 or 90 or whatever. So it was a substantial dividend payout. Now, I had rather a fortunate experience with DXD from the first week of December 2008 through to the last week of February 2009, because I bought it at $69.03 and I sold it at $74.70. But during the interim, I also collected the dividend of $16.05. So that was a really good, quite a good move. I gained about $5 on the stock price itself, plus collected a $16 dividend on a $69 stock, so that's pretty good. But it's still not as good as one might expect, because the Dow during that period dropped 19%, whereas DXD actually gained only 5.67%, although it did pay out a dividend of 23%. I'll put these figures in the more info section to the right of the video so that you can see what I'm talking about. In conclusion then, I have to say that these ETFs, these double ETFs and double inverse ETFs, in my experience and opinion, are absolutely superb, absolutely excellent, providing you get on the right side of the trade and have the fortitude to get out if you're wrong. That's so important, because they can go horribly against you. But, you know, for a trading vehicle, I don't think there's anything to be scared of on them, providing you, you're in control of the situation. However, having them as a buy and hold is just a recipe for disappointment. And I don't think they're a good hedge for a long portfolio. I think there might be better ways. I mean, cash is a short position. Sell half rather than buy one of these as a double hedge, maybe, you know.